Hello and welcome to today's video. Hope you are doing great. Have you considered owning commercial properties and earning rental income from them, but you need a high initial capital to buy? But my friend, REITs are the best option to consider. In this video, we will discuss real estate investment trust, which is shortly called as REIT, its types, advantages and disadvantages, and how you can invest in it. Let's start with what REIT is. REIT or the Real Estate Investment Trust can be described as a company that owns and operates real estate to generate income. Real estate investment trust companies manage portfolios of high value real estate properties and mortgages. For instance, they lease properties and collect rent thereon. The rent thus collected is later distributed among shareholders as income and dividends. Typically, REIT offer investors an opportunity to possess high priced real estate and enable them to earn dividend income to boost their capital eventually. This way, investors can utilize the opportunity to appreciate the capital and generate income simultaneously. Both big and small investors can park their funds into investment options and reap benefits accordingly. Small investors may pool their resources along with other investors and invest the same into large commercial real estate projects. Properties including a REIT comprise data centers, infrastructure, healthcare units, apartment complexes, etc. Now let's see the types of REITs. In broader sense, the types of businesses REITs are involved classify them better. Also, the method devised to sell and purchase the share further help classify REITs, which are as follows. Equity. This type of REIT is among the most popular ones. Typically, it is concerned with operating and managing income-generating commercial property. Notably, the common source of income here is rent. The second one is mortgage. It is also known as MREITs. It is mainly involved in lending money to the proprietors and extending mortgage facilities. Further, REITs tend to acquire mortgage-backed securities. Mortgage REITs also generate income in the form of interest required on the money they lend to proprietors. The other one is hybrid. This option allows investors to diversify their portfolios by parking their funds into both mortgage and equity REITs. Hence, rent and interest are source of income for this kind of REIT. Next is private REIT. These trusts function as a private placement which cater to the only extensive list of investors. Private REITs are not traded on the National Stock Exchange or registered with the SEBI. Next is publicly traded REITs. Typically, publicly traded real estate investment trusts extend share and listed on the National Security Exchange and regulated by the SEBI. Individual investors can sell and purchase such shares through NSE. Next is public non-traded REITs. These are non-listed REITs registered with the SEBI. However, they are not traded on the National Stock Exchange. Also, these options are less liquid when pitted against the public non-traded REITs. They are more stable as they are not subject to market fluctuations. Now let's see some advantages of the REITs. Investing in REITs provides substantial dividend income and allows steady capital appreciation over the long term. Since most of the REITs are traded frequently on the stock exchanges, it allows investors to diversify their real estate. Being regulated by SEBI, REITs are required to file financial reports audited by the professionals. It allows investors to avail information on aspects like taxation, ownership, zoning, making the entire process transparent. Most REITs trade on public stock exchanges and hence are easy to buy or sell, which adds to their liquidity aspect. Investing in REITs offer individuals risk-adjusted returns and help generate steady cash. It enables them to have steady source of income to rely on even when inflation is high. Now let's discuss the limitations of REIT. Regarding tax savings, REIT are not much of help. For instance, the dividend earned from REIT companies are subject to taxation. One of the significant risks associated with the REIT is their susceptibility to the market-linked fluctuations. This is why investors with a weak risk appetite should weigh in on the return-generating capacity of this investment beforehand. The prospect of the capital appreciation is really low in case of the REIT. It is because they return 90% of their income to the investors and reinvest just the remainder 10% of into the ventures. Now let's move. How can you invest in REIT? Like popular public stocks, investors may buy shares in the particular REIT that are enlisted on the major stock exchanges. They may do so via three ways. Stocks. Individuals looking for a more direct way to invest in REIT should consider doing so through stocks. Other is mutual funds. Individuals could diversify their investment portfolio significantly by choosing this option. Investors must invest in such a fund through a mutual fund company as an indirect investment method. Other is exchange traded funds. With this particular investment option, investors would avail indirect ownership of the properties and further benefit from diversification. Notably, REIT are the investment options resembling with the mutual funds. The only difference being that REIT holds property instead of bonds or stock options. It would be best if you always consider researching and understanding this investment option before making any investment decision. That's all for this video. Please consider subscribing to the channel if you found this video helpful. See you next time. Nikhil Dhawan signing off.